Sunil Singhania joins us now to walk us through what his thoughts on the current year and the coming year are. Sunil, fantastic to
Good
have you.
morning.
Thank you for joining us. We are breaking traditions. We are starting with you really early because we want to spend a lot of time with you analyzing not the year but also the decade. This decade, Sunil, it absolutely amazes me when we look at the data, has been dominated by only one thing: central bank policy action, low interest rates, and rise of mega caps. It's not only an Indian phenomenon, it's also a global phenomenon. A Microsoft, an Apple, a Google. How much of the current decade will translate into the next decade as well?
No, I think you are right. It has been predominantly policy action. And one thing we have to remember is that it is a continuation of what happened towards the end of last decade, which was Lehman and a lot of financial crisis. So I think this loosening and the central banks becoming active is a carrying forward from where the last decade ended. And it's been a phenomena where interest rates globally have been on a downward kind of a trajectory. And surprisingly, all assets have done very, very well, which is again very rare that, the fixed income guys have made money, the equity guys have made money, and towards the end, even the commodity guys, predominantly gold, has also made money.
No, small cap guys have not made money.
No, I think in the decade, small caps have also made money. I think what we end up doing, Nikunj, is that we start to look at the index of the small caps and we get a little bit, carried away in our negativeness because, towards the end of the decade, towards the last 2-3 years, we have had very challenging times, particularly in India, with tightening of liquidity, which is not a normal phenomena globally, but it was there. And there was risk aversion. So I think we get carried away with that. But otherwise, in the decade, good opportunities have come in the small cap side also.
Yeah, absolutely. But Sunil, as we look forward, this is no news that the headlines are talking something completely different, whereas the Nifty number is reflecting something completely different. Do you think the both will align at some point, or do you think at least index per se has sort of overseen that tide and now we're not going to get back to the lows?
So markets are a reflection of one, fundamentals, and secondly also flows. So you're right.
Sentiment. Which they've been not sort of aligning with.
Sentiments are, I would say, outcome of how the market behaves rather than, a precursor to it. I think what has happened, obviously, the fundamentals have not kept pace. And it's high time that the economy starts to now grow faster than what it has been growing. Otherwise, obviously, there is going to be a headwind for the markets. Having said that, I think the flows in the emerging market, particularly in the last 2 months, have been very, very high. And we get very happy that Indian markets have been up. I think in December, we are up, 1.5%. But if you look at Brazil, it's up 8%. You look at China, it is up 8%. Even Hong Kong, with all its issues, it is up 8%. So the last 1.5 months is predominantly an emerging market rally. And in fact, India gets the rub off positively because flows come also into India. But it has underperformed to that extent, largely because the economy has not kept pace. But going forward, I think we believe in optimism, we believe in hope. And at least we are quite confident that by March, we should start to see the GDP growth rate numbers coming at least 5.5-6%, if not higher.
A big catalyst just before that will be the budget. While there is all talk that there is going to be an income tax rate cut coming in, I don't know how much of it is going to really materialize in people buying more consumer goods. But besides that, from a market fraternity, what's the messaging to the finance minister? What is the need of the hour from the budget this time? Because we know they're going to miss on the fiscal deficit number as well.
So one thing is, I hope that the expectations don't go up too much before the budget. So if the tax rate cuts come and all, I think it is fine. Otherwise, I don't think we should put too much hope on that because of exactly the reason you mentioned, which is the fiscal deficit number. Also, I would tend to agree with one of the major economists who said that if India's fiscal deficit, if the finance minister comes and says India's fiscal deficit for the next 2 years is going to be 5%, it's not going to be the end of the world. In fact, after a knee-jerk reaction, in fact, all the markets should go up because it's a practice followed globally. When Lehman happened, the fiscal deficit in the US inched up to 9 and 10% because that was the need of the hour. So right now, if we need some extra money to be pumped into the economy to kickstart it, I don't think there is harm in the fiscal deficit going up to 4% or 4.5%. We have lived with that even earlier. And the good thing is we have a great foreign exchange reserves right now. We don't have to bother too much about that side of the economy. And I think even if the fiscal deficit, as I said, goes up a little bit, I don't think it's going to be the end of the world.
We just have a couple of minutes to go for opening on the last day of the year. So, so if I had to sort of put you in a spot, Sunil, and get a year-end target for December 2020 from you, what would it be?
I don't know. But I do think that this polarization of the market, it's high time it ends. And, I hear a lot of things, and even on tweets, that so many people are expecting the mid-caps and small-caps to outperform. It's become a consensus trade. But I think the guys who are tweeting are the ones who are having the view. The guys who are not tweeting obviously have been sitting on large caps and have been making a lot of money. The disparity in valuations is now very startling. And at some point of time, fundamentals have to catch up pace with the market. So I would say that equity will give you positive returns. I don't know what the headline indices might look like, but I think overall as a basket, I would say investors would be more happy in 2020 than they have been in 2029.
Sunil, from last, not 1 year, last 2 to 3 years, everyone on this forum who's seen 15-20 years of market is making a case that the mega caps are becoming not mega caps, but they're becoming large and obese. And the risk there is valuation, not business. But that view, in a sense, has not got vindicated because of liquidity and low interest rates. If we are in a world of low growth for a long time, which means liquidity will remain abundant, and if flows continue at the pace what they have been in the past, what happens then?
So one is, it's a very clear signal that there is now benefit of being large, and particularly in the e-commerce and the digital world, I think winners takes all. So, after Amazon, the second largest maybe is 5%, 10% of the size of Amazon. So that is also one of the reasons why the large have become larger, because in that segment particularly, the winner takes all. But in the other segments, because of this digital thing, I think the smaller companies also have a chance. Earlier, the largest FMCG company could demand all the space in a grocery shop. Now, because of the large format stores and because of e-commerce, even the smaller guys can have, so I think it will change. Definitely it will change. But in that segment, which is the digital world and the e-commerce, the winner takes all. And there the larger will become larger.
But 40 seconds to go, and it's the last trading day of the year. What has been called as a lost decade, but within that lost decade also in last 10 years, you've seen birth of a Bajaj Finance, birth of Indigo listed in the listed avatar, DMart listed avatar. So while there is reason to talk about the precipitous decline what in Unitech, ADA group of names, the Yes Bank has seen, the brighter side is that each decade gives you some disproportionate outliers. And for this decade, I guess the disproportionate outlier for me is actually Bajaj Finance, which was listed for the better part of this decade, Indigo, which listed a couple of years ago, and DMart has got a very recent listing history. So yeah, there have been a couple of outliers also in this year in terms of wealth creators.
All right, last day of 2019, last day of the decade. Let's see what the markets are throwing up. It's on predicted lines, a day of low volumes and a tempered start. So tentative at best at 12,245. Nothing going on with the broader markets either today. The breadth just about even Steven. Let's keep it with aviation this morning then, shall we? It's the Hindujas who are perhaps looking at revising their bid for Jet Airways. So a glimmer of hope there. In the meantime, Indigo, Etihad, PE players, they are eyeing the Air India cockpit. So some of these stocks in focus. There's telecom as well. Jio, of course, at the front of the pack, adding about 9 million subscribers. You've got Vodafone Idea, which has added about 1.8 lakh users, and Airtel, about 81,000. Meantime, Chalet Hotels has signed a pact with Marriott. Just a quick look at that stock. Gayatri Projects, that company has defaulted on 45 crore rupee dues. You've got BPCL. I just want to check in if the carry-on effect of yesterday's news break is playing out. Well, today a little bit soft at 490. HEG, meantime, LIC sells about 2% stake between November and December. Meantime, you've got all of those stocks which are holding out, the banks. some of the metals. Tata Motors, remember, was a star in yesterday's session as it's continuing with that up move. You had metals as well as auto, which took leadership in yesterday's session. And for now, it's looking very tentative, I'd have to say, across the board. So no one's really popping the bubbly.
All right, 218 rupees for Hindalco. We are off to a good start. So I think that is something which, I mean, today's market action and this week's market action, I would say we should not read too much into the price action, and we should not get too much carried away about small spikes here and small spikes there. Sunil, you know, we say in the market that courses remain the same and horses they change. Each decade, we like it or we don't like it, always gives these mega trends, right? 80s belonged to US, Japan, then came US, then came China. Last 10 years have been all about US. Which are the mega, not macro, but micro trends to your mind, which would be at play? Because ultimately what we are trying to talk here and discuss, Sunil, is that how to, you know, identify money-making ideas for our viewers. That's what the attempt here is.
No, I think very clearly one thing is obvious is that the return expectations have to go down dramatically. Because as you rightly said when you started, that this decade was more about interest rates going down. So, you know, we started with very high interest rates, which was in 2008-9 post-Lehman. And then the interest rates kept on going down. And now we are at the fag end of that cycle. Interest rates can't go down further from here. They can stay here, at least in most developed nations. So I think we have to be very clear that the return expectations have to be lower. Second is, I think these trends which we used to have for 15, 20 years, those cycles are becoming shorter. So, you know, you can't buy anything and keep it for 20 years. I think the disruptions will kill you if you don't do that. And the third, I would say, is that from an Indian investor's perspective, to the extent allowed, the Indian investor will have to start looking at opportunities of investing abroad also selectively. You know, because again, you know, we have seen that how in this year, for example, even US companies have given 30-35% return. I think in India, the trends are going to be very different and very difficult. We have already seen the consumption played out beautifully. So I would say consumption will continue to grow, but the valuations are such, I don't know whether returns will be made there. On the other hand, there would be the so-called, sectors which are facing headwinds, but which have I would say the core advantage of difficult to replicate kind of a thing, you know. So core brick and mortar sectors which have established factories, established cash flows, right now which are enjoying very low PE because they are out of fashion, they are boring sectors, but no one is investing in them. So ultimately, you know, those are the sectors which will start to make a lot of money. So I would say some engineering companies, some even commodity companies would be the companies which at least for the next 3-4 years can give very good returns. It's very difficult to call a decade because, as I said, you know, things are changing so
But you're convinced, Sunil, like you sort of warned everyone about 2 months back that there is a bubble in quality. So you believe that it's in one's best interest to reduce exposure there, if not completely exit?
So I think the idea of the note was to just give a perspective, you know. So whatever we have studied and whatever we have practiced, you know, when we invest in equity, there has to be some rationale to it. And it is all about buying profits when you invest in equity. And, you know, obviously if you're buying profits at 75 times, by paying 75 times its profit, then there is obviously, so I think that note was more to sort of alert investors that quality obviously is quality and it will always trade at a premium. But to what extent is what the investor has to be careful about. So whether the investor has to reduce or not will depend on the investor's perspective and the risk-taking ability. But as an investor, we would stay away from very high PE stocks unless the growth rates, you know, justify those high PEs.
And do you think there are any exceptions wherein the growth rates do justify the high?
No, there are some companies which continue to grow at 25-30%. Within financials, even outside of financials, but they are very, very rare. But I think by and large, I would say 90% of the companies which are trading at 60-65 PE don't have growth rates of more than 10-15%. And the perception is that these companies are growing at 20%, but when you actually sit down with the numbers, which unfortunately very few people do, you realize that even in the last decade, very few of them have grown even at the nominal GDP numbers.
You mentioned engineering, you mentioned commodities, you know, take us to some of the other themes that you're looking at, how stock specific you're going. Are you looking at size versus earnings? What's the rationale by which you're going to be investing as well?
So one thing is, at least for the next 2-3 years, our view is that obviously India is not going to go back to 7-8% growth rate in a hurry. And at the same time, the world is looking much better in terms of growth, particularly the US, and China is also stabilizing. Commodities have started to inch up. And with Brexit, hopefully there will be some growth even in Euro region. So we are looking at companies and sectors where they have decent, sales coming even from exports.
Okay.
So that's why I mentioned engineering. Commodities is linked to the world, and even pharma is starting to look interesting. Though in pharma you can't call the sector per se as a buy or a sell; it will be more stock specific.
Sure.
But with this 4-5 years of underperformance, valuations now at a decent level. Rupee at the margin at 71, which is obviously better for the exporters than what it was 3-4 months back, and also the fact that the regulatory headwinds are now reducing. In US particularly, companies which were in generics have started to face bankruptcy because of the sharp fall in the product prices. A lot of companies have gone into bankruptcy, and that is reducing the pressure on pricing for US-centric companies. So I think pharma can also be a very interesting.
So I'll pick up two themes, Sunil. One, what could be called as a super crowded trade, private banks, some insurance companies, and one which is a completely disregarded trade, that's PSUs. PSUs, not every PSU is bad. Some of them have, like Coal India, NTPC, they have so much of advantage that you can't replicate them, even good old BPCL for that matter. Financials is where the growth for next 2 or 3 years is visible, but that's where the FI ownership or the institutional ownership is very large. Which way would you lean as a money manager?
So I would agree that where there is consensus, normally money is not made. But I think the biggest wealth has been created in one of the largest private sector corporate bank, which is a consensus buy, but which still continues to do well because even the most optimistic numbers can be exceeded in terms of performance. I think on the PSU side, you are right that most of them are monopolies. However, the question mark there is that they depend on a lot of government policy actions in terms of what they would end up buying in terms of some other company or what they are going to do. I think we own the largest public sector public sector bank. But other than that, our view on other public sector companies is not that great. I think in this public sector bank, the FI ownership is only 9%. And I always tell my analysts that, foreigners own only $4.5 billion worth of the largest bank in India, which has 35% market share.
And also credit card business and also an insurance business.
No, that is all.
Many others.
So I think it's very, only $4.5 billion worth of a bank which has 35% market share and which is a decent bank. It is not comparable to private sector banks, but it is much better than other public sector banks. So I think there are pockets, but by and large, other public sector companies depend on a lot on what the government would want them to do. So I think if there is some indication from the government that they would not interfere in business, which has been there on and off. But I think if that signal comes in, that some of these companies can definitely give good returns.
Would you buy your own business? When I say your own business, mutual fund industry, wealth management, there are options now.
I think it's a great business.
On a serious note, I'm saying that
on a serious note. And the reason I became an entrepreneur was because I saw the opportunity there. So I think, again, I don't want to give our secrets because our investors will be watching, but this is the only business where, you make money for the entire life of one sale. So if we raise 100 crores, we make fees on it for the rest of the rest of the life till the investment is there with us, which is unlike any other product. So if Hindustan Lever has to make money, they have to sell every day. So I think it's a great business. The other thing is Indian people are getting richer and they're getting more organized. So the financial savings as a percentage of their savings is increasing. And every saving which comes in, the wealth manager and the asset manager obviously will have a role to play. So I think it has great future. On the listed space, things are expensive, unfortunately. So what is good is very expensive in India, but we'll have to live with it if the growth rates justify it.
We had a psychic and a tarot reader predicting that it would be the year for real estate post the budget next year. Do you see any silver lining for real estate?
I think the tarot reader has been a little late because the best performing sector for this year has been real estate.
Yeah.
So the tarot reader should have forecasted it last year.
But as a trend, Sunil, what is it that you foresee? You know, you rightly talked about financialization of the economy. That's really playing out as a trend. But the last 10 years, like you said, was all about consumption. What's that one big trend that you see play out for the next 10 years?
I hope it is going to be infrastructure. Because without that, I don't think we are going to be 5 trillion, 10 trillion, whatever we might believe and say and be the most optimistic. We'll have to do something about our infrastructure, and for that we need obviously spending, and it's a cycle. You know, you do the spending, your GDP growth rates inches up, which gives confidence to the foreign investors to pump in more money, and then it becomes a great circle.
Multiplier.
The way China has been able to do it. So I think that is something which we will need to do for this country to be a $5-10 trillion.
But what happens? We don't move the classic way, which is that we continue to dip on our savings, which is why the consumer boom has happened, because India's savings have gone down. The Indian consumer, they continue to leverage their balance sheet, which is why the growth in consumer durables and autos has come in. Not that job levels or income levels have gone higher. You are leveraging your balance sheet and your savings are coming down. What happens? We go the American way, which is that we continue to lever. Our economy does not do well, but the consumption as a theme continues to grow.
There's a difference, Nikunj. You know, I think if you look at the income tax returns, the number of income tax returns, you will get your own answer. So in US, if 90% of the residents are income taxpayers, in India it would be 5 or 10%.
Yeah,
so the
poor.
possibility of levering one's balance sheet is very limited. If you look at the housing loans, for example, you know, so there is the salaried class, which every bank and every housing finance company would be willing to lend, but then you have a big pool of self-employed people who would be showing the minimum income levels in their income tax returns, who would be having wealth, but not in an organized manner, and would not be able to leverage. So I think that ability is very limited in India. You know, it might last for a year or two, but by nature, Indians will not sort of mortgage their house to do consumption. So in the US, if your house worth $1 million becomes $2 million, the person would borrow another 1 million and go on a world tour. In India, we'll never do that. You know, the attempt would be, how do we get our mortgage out?
By the second house, or maybe.
From everything you're saying, it would seem natural that power would also stand to benefit. But given the kind of regulatory challenges the sector has faced, again, is that something that you would still take a risk on?
Actually, it can be a dark horse, and there are reasons for it. One is, again, technically, the power companies in India are a proxy to financials, because you have a fixed rate of return, so 13-14%, and if your risk-free interest rate is 6.5-7%, so typically they should trade minimum at 2 times book, but right now they're trading at 1 time book, largely because of issues related to power. And the other positive which can happen is that everywhere the government is wanting to privatize the distribution. So, we recently heard about Orissa, 5 circles being privatized. So a lot of these opportunities will come. And in that distribution space, the ROEs can be much higher than the 12, 13, 14%.
Sunil, we had the major IC event last week, 10 days ago, and we had one P investor followed by one classic old-timer. Manish Chokhani is exactly of your view, which is that, look, you can't buy consumption and you cannot buy these expensive stocks now. I also had Ranjan Anand from Sequoia. He said that, look, I'm focusing on the India of 2030, which would be AI-driven, data-driven, millennial spending, experiential and travel. How come you're not talking about these big themes which everybody is talking about?
No, so there are 2 aspects to it. I would agree that we have become old and we are old school. That is what you intend to say in a nice way.
So is the classic old investing dead, is what I'm asking?
No, so I don't think so, because what has happened in India, the Indians have spent on all you mentioned, but who has benefited out of it? All the foreign companies.
Foreign companies.
So I think I agree with Shankar Sharma in that respect, that India has been too liberal. we were not able to benefit out of our e-commerce. You mentioned Amazon, which is an American company.
Flipkart, Paytm, all of them.
So
Just every
So I
global
think,
company.
and China restricted them. So you have the Tencents and Alibaba and all, which the local investors were able to participate. So I think the trends will emerge even in India. But how many Indian companies will be able to benefit out of it? And I think it goes back to the earlier thing where I mentioned that the very rich Indians should start to look at investing abroad to the extent regulations allow.
Okay. Sunil, since we're looking ahead, we also thought that we'd look ahead and see how you will look in the next 10 years.
Oh, God.
So look at the screen and you'll know exactly. Can we have that image up?
Oh, wow.
Oops.
So that's the time machine going forward. Any thoughts?
I'll ensure that there are hair on my head.
But,
There's
Buffett
technology now available, 2030 of India.
Yes. Buffett has made...
2030, God knows what technology will come for.
So, Buffett has made 90% of his wealth after he crossed 60. You're not 60. So the best of few years yet to come. So is there a number you're chasing? I watched this movie Wall Street, and Gordon Gekko says every man is chasing a number on Wall Street. So what is the number you're chasing for this decade?
So frankly, obviously, I'm not a sadhu. So, there is a materialistic involved in whatever you do. But I think my joy lies in ever hunting for new stocks and researching them, meeting them. And I get the kick out of meeting the smallest of smallest entrepreneur. And I think the next decade, hopefully I'll have more time doing that rather than trying to chase being the largest AMC or being the biggest AMC or whatever, So I think that would make me more happier and wealthier, I think. I think wealth would be an outcome of something you do well.
Well, lovely to have you, and certainly look forward to much more engagements and long engagements with you.
No, thank you. Happy New Year, and Happy New Year to all the viewers also.
Yes.